The mere suggestion that the Trump administration might impose country-specific U.S. tariffs on 1 kilo gold bars was enough to jolt global markets within seconds. Prices shifted, trade flows stalled, and future spot spreads widened dramatically, especially after talk surfaced of a potential 39% tariff on Swiss gold. On trading screens, the gap between futures and spot prices in dollar terms surged toward the 100 mark. Refineries and logistics firms quickly moved to a wait-and-see mode, while airlines suspended gold shipments amid uncertainty over U.S. customs classifications. The central question became, which gold bars fall under which tariff category? Without written clarification from Washington, the trade chain slowed and equilibrium remained shaky. The disruption wasn't just about price, it was about gold's dual role as both a commodity and financial collateral. If a bar unexpectedly falls under U.S. tariffs, forward delivery schedules are delayed, and traders must recalculate the buy-transport-deliver chain with a new, U.S. risk premium, added to costs. This instantly erodes market confidence and complicates logistics. As the futures spot spread widened, risk appetite among arbitrageurs faded. Uncertainty about delivery routes, storage, insurance, and customs classification increased transaction costs and extended timelines. In gold trading, time is as valuable as price, and delays carry a heavy economic toll. Sector reactions. Jewelers quickly adjusted display prices in line with U.S. retail shifts. Electronics manufacturers, dependent on gold for connectors and plating, began scouting alternative suppliers. Refineries halted shipments until classification rules became clear. Even when alternative sources are found, the origin risk remains, especially if tariffs later extend to new countries. Without clear contract language specifying product codes, casting standards, and delivery terms, the entire supply chain hesitates. Switzerland, a key player in global gold refining and finance, faces particular pressure. If tariffs are implemented at high rates on a country-by-country basis, negotiations between Bern and Washington are inevitable. The outcome will influence trade flows across the London-New York-Zurich triangle. Why the 1 kilo bar matters. This standard weight and purity is the most traded unit in U.S. contracts. If it becomes a tariff target, the most liquid form of physical gold turns into a bottleneck. Costs rise, flexibility falls, and the trade network scrambles for alternative routes, often at higher transportation, storage, and insurance costs. Consumer impact. In the short term, U.S. jewelry prices will inch up with market momentum. In the medium term, inventory costs and narrow margins will weigh on retailers, while electronics makers may face higher component costs. If delays persist, retail demand could weaken and trade volumes shrink. Ultimately, the fastest and least costly solution is for Washington to issue a clear, written statement defining which products are affected, their origin classifications, applicable tariff rates. Such clarity would instantly narrow the futures spot spread, relax delivery bottlenecks, and restore trade confidence. Without it, the market will remain volatile, costs will rise, and U.S. consumers will bear the burden. For now, the gold market is holding its breath. Whether Washington resolves the uncertainty quickly, or lets the debate linger, will determine if this tariff scare becomes a brief tremor or a prolonged shockwave across the global trade network.